In this video, guys, let's look at how to trail a stop in a trending market. You're in a trade, it's going your direction, you want to try to extract as much as you can out of it. Let's look at the pros and cons of different ways of doing that. Stay tuned. Hey guys, warm welcome to you. While you're in the description section of the video, check out they're our channel sponsor, CFD Spread Bet, super tight spreads on a vast array of markets. I know many of you are using them, great feedback. You can use MT4, you can scalp with them, obviously regulated, of course, and you can use C-Trade as well, which is a pretty good platform. So go and check them out, guys. Pepperstone, link to them is in the description below. This is one of the things that really confuses traders. And guys, you know, it is confusing because there's no exact answer to this. You know, you're trying to extract as much out of the market as you can while still giving it room. And you know, you're never going to get this perfect because the tighter your trailing stop, the less room you're giving it. And so a little bit of noise takes you out. But then again, the wider the stop, the more you're giving back. It's a balancing act of how much am I prepared to give back on this profit of the trade versus, you know, how wide is my stop? So how much I want to give back versus how much I want to make. And so you're kind of looking at this and going, well, I'm prepared to give back, but I want the chance of making a lot more. Okay, well, if you want the chance of making a lot more, you're gonna have to be prepared to give a fair chunk back. And the more you give back, the more chance you've got of sitting through some noise and it going your direction, if that makes sense. If you really don't want to give any back and you tighten the stop right up, then your chances of it moving a good distance are slimmer as well. Can happen, but it's finding the sweet spot for you. Okay, and I always say this, guys, is the market conditions are super important. There's no point having the most ridiculously tight stop trailing if the market is kind of in ranges and then going up a little bit in ranges. It's much more wider rotations, the trend's not as steep and all this kind of stuff, because if you do that, you're just gonna get pinged. So judge the market conditions and play this game accordingly. All right, so let's imagine we're in this market here, we're kind of taking a trade, a little breakout on the highs, off we go, we're in. So we want to look at a place to get out. Now, I'm always a big fan of scaling out. So you can come out of a half a position, leave a half running, you can play around with it. So always a fan of taking something in an initial kind of pulse, initial move, take some risk off the table, personal preference, it's not right for everybody that, but then it's a case of, okay, how far can this thing go? Especially when you're trending market. Different if you're range bound condition, looking for point A to point B, take the trade off, done. Trending market, well, this guy's moving, let me just see how much I can get out of it. So moving average, pretty common one this, 5, 10 and 20, you're normally threes. Going any more than that, you're talking bigger rotations, talking about a daily chart. You know, 20 is going to hold most trends, 10 is going to be tight, 5 is when you're really like, I want to come out of this, but if this thing keeps ripping and ripping and ripping and ripping, then that 5 is going to hug that price so tight. And you might, in some cases, you might get 8, 9, 10 days move out of it. Most cases, you might get 2 or 3 day move and you're probably out the fourth. So judging how that keeps you in or not. Again, I'm going back to that equation of, okay, prepared to give stuff back, but the chance of it going higher. 20 period might keep you in the trade, and then it might go higher, but you're going to give some back for the cost of doing that. So that's something to work out. And then once in trading ATR, you can actually program stuff like this, you know, on MT4 and on TradingView, if you're using TradingView, any of the platforms, like a trailing stop that uses the ATR. So it says, okay, ATR is the average true range. Let's say it's running at 30. That can then trail up and say, oh, well, I use a 30 point or pip stop below the prior low or below the prior price or something. So it's almost like a volatility type stop. So rather than moving averages just based on price, ATR saying, what's the range? Okay, well, it might go up, you know, 500 pips and come down 300 pips. I need to account for that. Whereas moving average is going to go, wow, it's gone up 500 pips. How does that affect the average price? Let me print the moving average, print the moving average. So it's a similar type of thing, but something that can keep you in the trade longer and is much more in tune with volatility. So check out that using ATR. Okay, using a prior low. This is quite a nice, simple way of trailing a trade as well. You're going to trade, it's pushing up, great, puts a low in on the day, the next day you put a stop below that low, the next day you put a stop below that low, the next day you put, now, you can adjust this depending on the conditions. Very steep trend, great, use the prior day's low. If it's kind of not so much of a steep trend, less than 45-degree angle, then maybe you do X day low, and that X day low might be 3 day low. What's the low after 3 days? Let me put it under there. Let me put it under there. And so you've got, again, you're prepared to give a little bit back, but you're allowing the market to rotate, you're allowing it to have a little bit of noise in it. So 1 day low, super steep trend, 3 day low, something like that for shallower trends. And the simple thing of that is you just literally keep dragging it up. You go, right, I'm gonna drag it up, gonna drag it up, gonna drag it up, drag it up. You log on, drag it up, drag up, drag up. Simple. Fourth thing is use key support levels. So by the way, guys, if you're using this prior low type scenario, this would be your entry here, and imagine these are kind of intraday lows. Your stop would now be here on this day, your stop will be here, be here, be here, and then your stop will be here, and then finally you get stopped out at this point here. Now, of course, it goes higher, but that's the rules that you've taken. You've basically said to yourself, okay, I'm going to come out on the prior low, and it's broken the prior low, you're out. If you're using like an end day low, like 3 or 4, then the stop might be here, but of course you're prepared to give more back. This one might be a fast moving average, this might be a slower one. You get the idea. Use key support levels. So this is a bit more subjective, of course, but if the market's kind of pushing high, imagine now then it starts sitting here, and you could say, well, that's a decent support level, so I'm going to use that as a level to get out. I'm going to wait until it puts a support level in. Now, the subjective nature of this means that you might end up going, well, you know, where's the support level? And maybe it doesn't put support level in. Maybe it just comes straight up and come straight back down again, in which case you're like, well, you know, there was no support, real support. I kind of used the low, but what I mean by support is like a level that actually sits there and, you know, puts a proper level of support in on the way up, and then you go, right, there's my level, there's the place to put the stop, something obvious to put the stop under that. So subjective, downsides of that, you might not get one, it might shoot up. The good positive sides of that are that as it's support, you would expect it to hold. You have your stop underneath it, it's a kind of place to pull the stop up and say, okay, well, if the thesis is right, if this trend is going to continue, that support should hold. That's another way of doing it. My personal preference, if I'm in like a really strong market, I like using the prior day's low if I'm swinging a trade. If I'm in a kind of day trading environment, so a shorter term time frame, maybe I'm day trading a market off the low, I've caught a nice little bounce off the low on a DAX or FTSE or Dow or something. I've traded FTSE for a long time, but it's an index, for want of a better word, off the low. Then I might go, okay, I don't want to be too aggressive with putting the stop up because it's going to have some noise. Let me wait until it moves in my direction, find some support, pull the stop up below that support. So I like to play that support game, or using the ATR is quite good as well on the smaller time frames, because that takes into account the volatility. So a 15-minute ATR is X. All right, well, that's going to be my stop. Just keep bringing it up, bringing it up, bringing it up, bringing it up. Whichever way you do it, guys, the beauty of the trailing is that it allows you to really take advantage if the market is ripping your direction. And something to consider as perhaps part of your strategy. Most people have fixed exits all the time. I'm a big fan, if I can, leaving at least a portion of it to run, because you just don't know where it's going to run. And the beauty of that as well, guys, very quickly, is that you start getting data on whether you should be running trades. Because if you start to run trades with a trailing stop and you go, you know what, 50% of the time that trading stop gives me an extra 3R, well, you know to run all of the trade. You know that on those conditions, in that environment, with that strategy, running all of the trade is a better bet than just running a portion of it. It's data, it's useful. A link in the description below. Appreciate your support. If you like this kind of stuff, you know the score. Thumbs up is appreciated. Bye-bye.